Okay, let's get going. So, welcome. For those of you that have joined us before, welcome back. For those of you that are joining us for the first time, hello, and you know, a lot of this will be news for you. For those of you that are joining us, have joined us before, we do have some new information from the ministry around free zone treatment. So this should be quite insightful, and hopefully give you a bit more direction on where the ministry is leaning. As we go, you can send through questions. There's a Q&A button down the bottom. Feel free to just pop those in as we go. I'll try and answer them at the relevant time. And thanks to those of you that sent through questions ahead of time. We've tried to, as always, incorporate that into the webinar as well. Just saying before, apologies, we're a bit late. We just had a bit of trouble setting up, hence why I'm in the studio with the white background instead of in the usual office. But hopefully it's not too blinding for everyone. Okay, I'll just bring up the presentation. Tim, feel free to send through the questions as we go, because if we don't answer it at the right time, or sorry, as through the presentation, then we'll answer it as at the right moment. So let me share a screen. Sorry, one moment. Okay. The first question that we always get is, when am I taxable? Okay, and the first part of answering this question is actually determining your financial year. Now, we get a lot of clients who have never actually had to do any kind of financial reporting ever, which is completely understandable, because up until now, there hasn't been a reason for many companies to do any kind of financials. The only mandatory requirements is if you had to do an audit for your free zone, or if you were registered for VAT, for example, so you had to do that regular quarterly bookkeeping. But what we find is that I'd almost say the majority of our clients have never had to do any kind of financial reporting before. So the first question is, well, I don't even know my financial year. So the financial year is quite easy to determine. If you are in a free zone other than DWTC, or if you are in the mainland, then normally what happens is your financial year will automatically default to calendar year. It's a bit different in your first financial year. So in your first financial year, generally you'll either run to the end of the current calendar year or the end of the following calendar year. But pretty much in all cases, from year 2, you will be aligned to calendar year. There are 2 exceptions to this. One is that if you are in Dubai World Trade Center, they treat the financial year slightly different. So they look at the month that you register. And then from that date, from that month, you run 12 months. And then you follow that pattern each year going forward. So let's say if you registered in April of a certain year, then your financial year runs April to March every 12 months. Whereas if you were registered in, let's say, Ras Al Khaimah, in Rakiz, and you registered in April, your first financial year would go April to December of that year, and then you go January, December going forward. This is important because it determines when you are taxable. Okay, so the easy rule is that for all of those mainland and free zone companies other than DWTC, Oh, sorry. The other exception is if you've ever actually changed the financial year yourself. You'd normally know this because you would have done it via a director's resolution. So if you're not sure or you don't think you've ever done it, the likelihood is that you have never changed it. So the vast majority of people will have a financial year January to December. So there is quite an easy rule for determining when you are taxable, which depends on your financial year. If your company was registered prior to the 1st of June this year, then your first taxable year will start on the 1st of January 2024. That's unless you're a DWTC company. So if you are registered prior to 1st of June this year, that means either you are already aligned to a calendar financial year, so you go January, December, or if you only registered this year, then your first financial year is running up until 31st of December this year, and then you become taxable from the 1st of January 2024. So for you, tax basically doesn't exist in 2023, or corporate tax doesn't exist in 2023. It only exists for 1st of January 2024. And so all of the administrative steps and everything that we're about to talk about, apart from registration, but it all sort of applies from that 1st of January 2024. The other side of this rule is that if you registered after the 1st of June this year, or if you opened your company after the 1st of June this year, you're effectively opening your company into a live tax environment. So your first financial year starts, when you open the company, and so you're taxable straight away. So if you just opened your company this month, for example, that means that you are in a tax environment, you are taxable as of now, and so you need to be underway with all of your compliance steps. Okay. So yeah, bit of a long-winded way to explain it, but the general rule, unless you're DWTC, the general rule is if you registered your company before the 1st of June, then you won't be taxable till 1st of January 2024. If you registered your company after the 1st of June, then you'll be taxable already. Okay. So, So there's 3 things that you'll probably hear me repeat over and over throughout this presentation, which are the mandatory requirements, regardless of what bucket you fall into, regardless of what free zone you're in. The mandatory requirements for compliance are pretty much the same. So if you are a taxable business, if none of the exemptions apply to you, you'll need to register, you need to do your accounting, and you'll need to file a tax return. Exactly the same if you qualify for the small business relief. You'll still need to register for corporate tax, you still need to do all your accounting, and you still need to file a tax return. Think of it as, you can't just go on trust with the Federal Tax Authority. You need to demonstrate to them that you qualify for these things, right? So even if you qualify for an exemption, you still need to be able to illustrate that to the tax authorities. And that becomes especially relevant if you are going for one of the free zone exemptions or for the qualifying free zone exemption. You'll need to register, you need to do your accounting. You have an additional step, which is that you need to do an audit if you're going for a free zone exemption, and then you'll need to file a tax return. Now, obviously, we'll go through all of the bulk of this webinar will be explaining these exemptions. But I always put this slide first to make sure that everyone is aware that regardless of the outcome, of your tax status, you still need to go through these steps. All right, so we'll be focusing on sort of 3 areas of the legislation through the webinar. The main one, well, a lot of it will be spent around the qualifying free zone person rules, mainly because there is a lot of interest around this, but to sort of set the tone early, the free zone rules are quite narrow and quite limited. So I can just see, for example, Tim's question around offshore, offshore revenue, offshore working. So there was some indication or some understanding originally in the original documents that a company that had 100% of revenue coming from outside the UAE, a free zone company with 100% of revenue coming from outside the UAE, the expectation was that kind of company was going to be exempt. Now, that's not the case. Instead, it is going to be activities-based or free zone-based, and we'll go through that in detail. But I just want to set the tone, set the expectation early that whilst we will be spending a lot of time on this, there is quite a narrow group of companies that will be qualifying for that free zone exemption. We'll spend a little bit of time talking about the small business relief, which is sort of the fallback for companies that don't meet the free zone exemption. And then, of course, the existing tax-free threshold, which applies for taxable businesses. Okay, high level first for qualifying free zone businesses. So the rule is 95% of your revenue must be what they have called qualifying income. Now, that is income which comes from either within free zones or from qualifying activities and is not excluded income. Now, we'll go through those in detail, but I just want to highlight there are some other attributes of the free zone exemption. So you also need to meet the economic substance requirements. Now, for some people, that's a new term, economic substance. That's probably a separate conversation, but that is sort of a mandatory requirement for every business in the UAE to look at. It checks that you are actually doing business, you have economic substance for your business here in the UAE, and you're not just using the business to shift profits around to avoid tax from other countries. The other attribute of the qualifying free zone exemption is that it goes beyond 2026. Now, this becomes relevant when you have companies that are weighing up whether to go for a free zone exemption, if that's available, versus the small business relief. The other thing is there is a bit of confusion around whether free zone companies can have to go for the qualifying exemption, or whether they can also go for the exemption rules or the relief rules that are available to normal taxable businesses, such as the small business relief. What the laws have stated is that a free zone company can opt out of the free zone, the qualifying free zone rules, and elect to be treated as a standard business, which then means they can take advantage of the small business relief rules, which is the next piece I want to look at. So, small business relief. What we've found is that due to the narrow definitions of the qualifying free zone activities, we are seeing more and more companies, or I'm seeing more and more clients that will be relying on the small business relief rules to not be paying corporate tax. So what these rules say is, if it's a black and white test that looks at your revenue. So if your revenue or your turnover is less than 3 million dirhams in 2024, then you won't have to pay corporate tax. Now, you only can take advantage of this if you opt out of the free zone exemption. So let's say you are a marketing consultancy business, which I'm using as an example, which wouldn't qualify for the free zone exemption. You may opt out of that because you want to take advantage of the small business relief. And if your revenue is less than 3 million, then you won't be paying tax. Now, the key thing about the small business relief is that it's only available up until 2026. And so your 2027 financial year, if you have let's say you have 2.5 million dirhams of revenue each year, and you went for the small business relief, you wouldn't be taxable in 2024, you wouldn't be taxable in 2025, you wouldn't be taxable in 2026, but then your 2027 tax year, you would be taxable. Now, what I meant by the black and white test is if you have less than 3 million revenue, you're not taxable. The moment you go over that 3 million dirham threshold, your profit becomes taxable. So just drawing the difference here between revenue and profit. So the small business relief looks at your revenue and goes, all right, is your revenue less than 3 million? If your revenue is less than 3 million, great, no tax to pay. If your revenue is more than 3 million, then they look at your profit for your tax. Okay, they don't look at your revenue for your tax. Tax is always done on profit. But this is just a test that is done on revenue, which is it's just an extra rule on the side that the ministry is allowed for the first 3 years. Currently, there is no indication that you'll need an audit for the small business relief rule, unlike the free zone exemption like we talked about before. Now, one difference here, which is relevant to the next slide, is that tax losses cannot be carried forward under the small business relief. Okay. Okay, next slide. I'll pause. So once we've gone through the slide, I'll pause and answer some questions. So let's say that you don't qualify for the free zone exemption. Your revenue is more than 3 million dirhams. Therefore, you are a taxable business. So the way that the tax is levied is your first 375,000 dirhams is tax-free, and then any profit over that 375,000 is at 9%. So if you make a profit of 360,000 dirhams, you're paying 0% tax, or you're paying 0 dirhams of tax. If your profit is 400,000 dirhams, you're only paying 9% on 25,000. So it's only the amounts over 375 that you're paying the 9% on. It's not a case of, you go over 375 and you pay it on the whole lot. It's basically the first 375 is tax-free, and then you get taxed on the profit over 375. One of the things that is worthwhile considering here, if you're looking at, all right, do I go for small business relief, is you can carry forward losses if you don't go for small business relief. Now, what this is relevant for is if you are a new business, and you think that you expect to make a loss for the next couple of years or even the next 3 years, and you want to carry that forward beyond 2026, 2027, you may elect not to go for the small business relief so that you can carry forward those losses for the first few years. And then when you do make a profit, let's say in 2027 or beyond, then you can use those losses to offset that profit. Now, I'm not expecting many. Well, I haven't spoken to many clients who will be in that position. Normally, they may make a small loss this year, but then they're looking at profits next year. But we do have a couple that are, a couple of businesses that are expecting to make pretty significant losses in the first few years while they get started, and then move to a profit position. So they may elect to not go for the small business relief, even if that is available. Okay, I'll do a quick scan through the questions. Starting from the top. Newly formed corporation in its first year with less than yeah. So every company still needs to do all of the administrative steps. So even if you're brand new and your profit is less than 350K, you still need to register, you still need to do accounting, and you still need to file a tax return. Now, unlikely that you'll be paying any tax, but you still need to go through those steps to show the tax, the tax authorities that you don't have any tax to pay. Can you change the financial year if you're a DWTC company? Yes, you can. It's worthwhile having a look. So changing a financial year, what you can't do it. I mean, the rules state that you can't do it purely for the sake of avoiding tax. So you can't, start pushing your financial year further and further back to avoid becoming taxable. But let's say you have a company in the DWTC which has a financial year which is not aligned to other companies that you have, or you may want to move your DWTC company to calendar year to align with, the majority of the country. Then that's something that you can justify and do. What we have found is that some DWTC companies, for example, ones that were registered in May purely by chance, they are not taxable until May next year. So they've got a few extra months. So they're going to probably keep that in place, delay, the tax implementation, and then change it, align it to January, December going forward. Okay, mainland company registered in November 2023. So how do we file the tax? Oh, we'll get to tax filing in a bit. Sorry, I'm just scanning through the questions quickly. I'm just going to answer the ones that we might not cover in the next couple of slides. Question about audit for qualifying free zones. So we don't know exactly what the audit will entail, but I expect the ministry will want the certified auditors in the country to be able to verify the tax rules. So if you are a free zone company and you want to validate that you have done the qualifying activities, then I expect that you will need an audit stamp to agree with you, so that the tax authorities themselves don't have to do that. We will run through some examples. Sammy, this is a question around the small business relief. So if you earned 3.5 million of revenue, would you be taxed on the full amount of profit or only the profit gained from the 500K? No, so if you earned 3.5 million of revenue, so you wouldn't qualify for the small business relief, you would be taxable on all of your profit. So if your revenue was 3.5 million and your profit was 2.5 million, you'd be taxed on the 2.5 less the 375 tax-free threshold. They don't try and apportion it for the extra 500, they don't try and apportion it for the amount that you go over the 3 million. Okay. Question here, is there a fixed format for the accounts or can it be done on Excel sheet? So the ministry have said that the accounting needs to be done under IFRS, so International Financial Reporting Standards. All of our clients, we put on special software that makes sure that all of the accounts are done, to that standard and under that format. It becomes pretty difficult to try and do it on an Excel sheet. I wouldn't recommend that. At minimum, you need to be looking at accounting software to make sure that everything is recorded correctly, so that you can reliably apply for the relief or the exemptions that are available. Tax-free threshold of 375,000 dirhams is irrespective of revenue. Correct. So the only time that the ministry will really look at your revenue is for that small business relief. Tax is always levied on profit. And so the tax-free threshold is 375,000 on profit. Okay. Question, when do you need to notify the authorities of your tax status if you're only liable to register from 1st of April 2024? So you're liable to, the registration is open now. It's not like you're liable to register at a certain time. Well, I mean, you do need to register at some point, but the best approach is to register now. You don't have to declare your tax status now at registration because, you know, it's almost impossible to know exactly how the operations will pan out. It's not like VAT where you declare your status at the time of registration. For corporate tax, everyone does, you know, the same registration or pretty much very similar registration, and then it's only when you come to do your tax return after your first taxable year that you declare your tax status or your taxable income. Question from Martin. I made no profit or loss for the past 2 years since I opened the business. Do I need to file any documents? Yeah, so same rules apply. So you will need to register for corporate tax. If there's no activity at all in the business, then you won't have any accounting to do because there's nothing to account for, but you'll still need to file a tax return showing the nil activity. Okay, I'm just scanning through some more. I think most of these we're going to cover. So if your revenue is above 3 million and your profit is below 375,000, so that would mean that because your revenue is more than 3 million, then the tax authorities will look at your profit. But if your profit is less than 375,000, that means you won't pay tax because you're under the tax-free profit threshold. Okay. Will you need to specifically apply for small business relief? Yes. So at the time of filing your tax return, now obviously we don't know what this looks like yet, what exactly what the form looks like yet. The way this works in other countries is when you submit your tax return, you will be able to elect, yes, I'm going for the small business relief, or yes, I'm applying for qualifying free zone exemption. These will be categories under which you file the tax return, and that will be after the end of your first tax year. It's not a case of having to try and predict this and try and declare it at the start. The time of registration is the same as, it will be the same across the board. It's only when you go to file the, the final return after your first year that you'll need to account for or declare for these exemptions. Okay. Giovanni, yes, the registrations have just opened for free zones. That was a couple of weeks ago. So there was no announcement for it. We have been trying to get some registrations in free zones, for the past couple of months. We got told off for jumping the gun, but they haven't announced that it's been open. But we're now finding that we are able to register all the free zone companies or our free zone clients. So it's up and running now. Okay, let's jump into some detail. So qualifying free zone exemption. This is the one I want to talk about most today because it's where a lot of questions come from. So I mentioned earlier on that there was a understanding, or there was a expectation that a free zone company which only derived income from outside the UAE, there was an expectation that those companies were going to be exempt from corporate tax. That is not the case. So the ministry released the free zone laws at the start of last month, and a company which generates 100% of revenue outside the UAE is not automatically exempt. What they came out with, what they have decided instead, is sort of a two-tier or two categories by which a free zone company can qualify for the free zone exemption. It is quite complex, and it's not actually split out into categories like this. I've done this to just try and make it a bit more simple to understand. But what they have said is you need to have 95% of your income as qualifying income. And therefore, conversely, a maximum of 5% of non-qualifying income or excluded activities. So there's two categories to derive qualifying income. So the first one we look at is the client location. Now, what these rules say is that 95% of your revenue must come from within the free zone system. So 95% of your revenue must come from other companies in free zones. Okay, so revenue from outside the UAE does not count towards the 95%. And obviously revenue from the mainland UAE does not count towards the 95%. So let's say you are a UAE business, a free zone business, and you only have one or two clients, which are both in free zones, they're free zone companies. That means that 100% of your revenue is coming from within the free zone system. It can be within your free zone or other free zones, but it needs to be in a free zone, or the client needs to be in a free zone. That means you would qualify for the small business, for the qualifying free zone exemption. With one exception, which is excluded activities, which we'll talk about at the end. But to make it simple, if 95% or more of your revenue is coming from other free zone companies, then you should qualify for this free zone exemption. Okay, the other category, and this is where it gets pretty complex, is the qualifying activities. So 95% of your revenue must come from one or a combination of these activities. Now, this is not mutually exclusive from the last rule. So you can have a combination of companies, other companies in free zones and qualifying activities, and it needs to make up 95%. But you don't need to meet both of these categories. So it's not a case of, you need to do the qualifying activities with free zone companies. So you either have 95% of your clients within free zones, or you can meet the qualifying activities category. So the qualifying activities, the list is quite narrow, as you can see. Now, I've just copied and pasted these straight out of the legislation so that there's no confusion or no doubt around this. Now, up until last week, this is the only guidance that we had around what these qualifying activities are. However, last week, and this is the latest development, the ministry released a consultation document. So we'll go into that in a second. But what I first want to establish is these two categories by which you can qualify for the free zone exemption. So the first one is, are 95% or more of your revenues coming from other free zone companies? Or do you do one of these qualifying activities, and is 95% of your revenue coming from these qualifying activities? And we're talking about UAE free zones here, right? So just the UAE free zones. So just for a question here from Ramsey. Oops. So only 95% of revenue from UAE free zones. Obviously, the UAE has no control over free zones around the world. Okay. Just quickly, I want to talk about excluded activities. So in the last two slides, we've talked about 95% of revenue coming from other free zone companies or from qualifying activities. Now, that 5%, right, can be made up of non-qualifying activities or non-free zone income, or excluded activities. Now, excluded activities, it's a bit of a, and I understand this is getting quite complex. Excluded activities can't contribute to your 95% revenue. Okay. The most important one, I think, especially for free zone companies, is point A. So any transactions with natural persons. So what that means is if you are selling to an individual, right? So if you are a free zone company and you are selling to an individual, there's no way of telling that that individual is a free zone company. And obviously they're not, because they are a person, not a company. So that can't count, there's no way of classifying that revenue as coming from a free zone company. So if you are selling to individuals, then it's going to be very hard to prove the activities, to prove the location of the client. So sales to individual persons cannot contribute, cannot make up the 95%. And then, the rest of them, I don't have too many, too many clients who are doing things like insurance or banking activities. Okay. The consultation document. Oh, sorry. And Ilya has just asked the question. So for a free zone company to qualify for 0% corporate tax or for the exemption, it either has to have 95% of its revenue to come from other free zone companies, or 95% from qualifying activities. That's right. You don't have to meet both of these conditions. It can be either or. It can also be a combination of both of them. So, if you have 50% of your revenue from a non-qualifying activity, but it's coming from another free zone company, and then you have 50% of your revenue coming from outside free zones, but it's from a qualifying activity, you can combine those to get 100%, 100% of your revenue as qualifying income. When we get to the combined thing, it gets a little bit complex. But the main thing is the two categories you don't have to meet both of them. Basically, you can do one or the other, or a combination, as long as it makes up 95%. Okay, so moving to the consultation document that the ministry released last week. This is providing guidance or further or seeking feedback around these qualifying activities. Now, what a consultation document does, just as a bit of a background. So what the ministry does is they say, all right, here is the law, here is our thinking around how this will be applied. And they go out to the public and to tax professionals, and they say, please provide your feedback on how we intend to apply this. Okay, so it is not law yet. And for example, there was a consultation document released for the actual whole corporate tax regime. And a lot of feedback, but there was quite a lot of difference between what was put in the consultation document, especially around free zones, versus what was actually released in the final law. The reason I'm saying this is, this is an indication only from the ministry. It's not the final law, okay? But it does give us some guidance around where they are heading. And so that's why I want to cover it today. Now, I'm not going to cover every single one of these qualifying activities. I'm just going to cover the ones that I think are, most interesting or most relevant, plus the ones that I've received questions on, or that most of my clients have been impacted by. So the first one I want to talk about is the distribution of goods or materials from a designated zone. So this is the one that was quite a complex term in the law. But what this consultation document has provided is some guidance around companies that operate in a, outside UAE shipping, commonly called drop shipping model, right? So this is where you are a UAE company, right? And you purchase goods from a supplier in, let's say, China, and you ship the goods to a customer in Europe. The goods never touch the UAE, but you receive the money obviously from the client, and you pay the money to the supplier, in those foreign countries. Now, we weren't sure whether that was going to be exempt or not. However, what the ministry have said is that that will be a qualifying activity only for free zone companies which are registered in designated zones. So if you are a registered in a designated free zone, then a dropship model will be exempt. Again, this is just a consultation document. It may be that the ministry comes out later on and decides that they're going to expand this to all free zones. Who knows, right? But right now, their thinking is that designated free zone companies, so JAFZA, for example, will be able to operate this dropship model and remain exempt from corporate tax. This is probably the most significant part, I think, of the consultation document, because dropship companies, there are a huge amount of them in the UAE across designated zones and free zones, and so there's been a lot of interest around this. And just to clarify, designated free zones are normally sort of the ports, so JAFZA, and normally designated zone relates to treatment of customs, really. So import, export, designated zone, you can land goods and it's not deemed to be imported into the UAE, but once it leaves the designated zone into the UAE, that's when it's deemed to be imported. Okay. Now, yeah, my final thought on this is that given the volume of companies in the UAE which operate this type of model, I think there will be a lot of feedback saying, well, if this law is implemented this way, as they've stated, there will be a lot of movement of companies from free zones into designated zones. I'm not sure that is something that the tax regime would really want to cause, or that kind of movement. So maybe there may be scope for an expansion outside of the designated zones. I wouldn't recommend anyone jumping the gun and going, moving their company to a designated zone yet until we get the final laws. Okay. The next one, logistics services. Now, you'll note that all we had up until the consultation document was these two words, logistics services, which created, I think, a lot of hope that around what logistics services would include. Now, what they have said, what the ministry have come out with in this consultation document, is that it is all around the transportation of goods, or the storage of goods and materials, right? There is, and so look, this definition that they've released in this consultation document is pretty straightforward. So, if you're doing handling, you're doing container storage, you're transporting the goods, inventory and order management, I think, is a key one, especially because what a lot of companies here in the UAE do is they may not necessarily handle the goods, but they provide a lot of services around logistics services. So inventory management, brokerage services, freight forwarding. So the definition that they've provided here gives us a little bit of positivity, because I do have there are a lot of clients out there who provide services strictly around these activities, or completely embedded in these activities, and so the expectation is that they will be exempt from corporate tax. One thing to note with this is that if you are providing, so if you do all of the logistics and then you provide the final, what's called last mile delivery. So let's say the goods come into your warehouse in the free zone, but then you deliver them out to a person, in the mainland. That portion of the income, so that last mile delivery income, that will not be qualifying income. So that would not count towards the 95%, it would count towards the 5%. The question here, are all free zones designated zones? No. So only some free zones are designated zones, which is why, I think we may see, which is why we need to wait for the final laws to see if they stick with, this, and this concerns the distribution piece. Jump back here. If they stick with this model, this format of the law, where only designated free zones are exempt for dropship, then we will see a lot of movement of companies from free zones to designated, non-designated free zones to designated free zones. But let's wait and see if they open this to all free zones as well. Okay, the last one is the manufacturing. So they gave a bit more context for the manufacturing. Nothing really unexpected here, so I won't spend too long on it. But what they did say is, look, it includes both what they've called fully fledged manufacturing. So when you are the manufacturer yourself and providing, selling these goods directly out from your factory, obviously that was always going to be included. But what they have also said is that if you are a contract manufacturer, so if someone pays you to manufacture the goods on their behalf, even if that contract, the contractee is a mainland company, if you are in a free zone doing the manufacturing, then that will be qualifying income. Okay, sorry, we've kind of raced through that. I wanted to, I don't want to, we don't have time to go through all of the other activities, but I think those are the ones that are probably most commonly being looked at especially across our client base. I'll quickly jump to a couple of examples. So I'm using the example of so we'll go down the left-hand side first, right? So I'm using the example of a marketing consultancy because that is very unlikely to be a qualifying activity. So let's say you are a free zone company, you do a non-qualifying activity such as marketing consultancy, 100% of your revenue comes from offshore, you will not be exempt. Now, this is the one where people were expecting to be exempt, but the laws have come out quite different. And so a non-qualifying activity, even if all of their revenue is coming from offshore, is not going to be exempt. Similarly, the one below that, so I'm on the left-hand side of the screen right now, a non-qualifying activity, such as a marketing consultancy, 90% of revenue is to free zone companies and 10% of your revenue is to the mainland. You're not exempt because it needs to be 95%, right? I'm going to jump across to the right from that one to contrast. So non-qualifying activity, but 95% of your revenue is from free zone companies. That means you will qualify because 95% of your revenue is going to coming from free zone companies. Okay, sorry, I'm jumping a bit out of order here, but going top middle. So a free zone company, right, which is doing a qualifying activity such as aircraft finance. If 100% of your revenue is offshore, and I'm just using this to contrast, right, they will be exempt. It doesn't actually matter if their revenue is from offshore or onshore or anywhere, but it is the fact that they are doing a qualifying activity, which means that they meet the exemption criteria. And so if you go to the one on the far right, by contrast, so qualifying activity, but 100% of their revenue is from onshore, it makes no difference. They still qualify as a free zone person. The key here is the qualifying activity. Now, and sorry, jumping, just one thing to note. So back all the way to the left, so the free zone companies doing, which are not exempt, they may qualify for the small business relief rule if they opt out of the qualifying free zone regime. If their revenue is, they can go for the small business relief rule if their revenue is less than 3 million. Now, just to finish, I'll quickly have I've been going through the questions roughly as we go. Free zone companies selling consultancy services only, doing no trade in any goods. So generally speaking, free zone companies that are doing services won't be exempt, unless they are only selling, or 95% of their services are being sold to free zone companies. Services may, they may qualify if their services are embedded in one of the qualifying activities. So if your services are embedded, for example, in the shipping industry, then you may qualify, because there is a clause in those qualifying activities which says that if you are providing ancillary services for one of the qualifying activities, then you are exempt. But I think it's going to be quite strict criteria about that. So you must have, you pretty much have to be completely embedded in the shipping industry with your services to take advantage of that. Okay. Rakesh, your question, even if we're simply doing cross trading, no goods enter or exit UAE, are we still liable for tax? So that's the part we were just covering then, where it's, the consultation document indicates that if you are registered in a designated free zone, then you won't be liable for tax, but a free zone will be liable for tax. We need to wait until the final laws come out. Okay, so Tim, your question, how do you opt out of the free zone exemption? So that'll be done at the time of filing your tax return. So if you're a free zone company, you'll elect to go for the qualifying exemption, or you'll opt to be treated as a taxable person. Now, exactly what that's going to look like, we don't know yet, because we haven't seen the final submission forms, but that's how we expect it to play out. Question here, so from Ilya, so when the free zone company doesn't meet either of the two 95% revenue requirements, does it mean that the company is liable to pay 9% corporate tax on all of its income? So if you don't meet, if you are a free zone company, your first preference is to try and qualify for the free zone exemption, because you want to maintain that going forward. If you don't qualify for those, then you will become a taxable person, right? You won't pay tax if your revenue is less than 3 million dirhams, if you opt for the small business relief. But if you are a free zone person, you don't qualify for the free zone exemptions under either category, your revenue is more than 3 million dirhams, and your profit is more than 375,000 dirhams, that is the only scenario in which you will be paying tax. So it's a few criteria to go through before you are paying tax. But yes, a free zone company which doesn't qualify for the exemption, the free zone exemptions, has more than 3 million dirhams revenue, and has more than 375,000 dirhams of profit. That is a scenario where a free zone company will be paying tax. Okay, so just quickly to finish, revisiting just a reminder on the mandatory requirements every single company has to do, regardless of your qualifying free zone. If you are small business relief, if you're a taxable business, everyone needs to register. You all need to have accounting done under IFRS, so International Financial Reporting Standards, and you all need to file a tax return. If you're going for that qualifying free zone exemption, you'll also need to have those financials audited. And of course, we at Virtue Zone Accounting and Tax, we provide all of those services. We would love to help you out. Obviously, registrations are now open, so we are underway with registering all of our clients. We've got great deals on at the moment where you can come and take one of our tax packages, even if you're not taxable until the 1st of January, you can come take one of our tax packages now. We'll start your bookkeeping now for free, so you get half the year for free of bookkeeping all the way up until obviously the end of 2023, and then we carry on all the way through to the end of 2024, all included in the package. File your tax return at the end of, after 2024, and you pay no extra for that extra time period. So I think it's obviously biased, but I think it's fantastic value. You're effectively getting half a year's bookkeeping for free, and means you're totally compliant. You have nothing to worry about, and we take care of it all for you. So please, if you're interested in that, drop me an email. I think you'll all have my details from the invitation. We would absolutely love to help you out. If you have any other questions, also please send them through to me. Always happy to help. And thank you all very much for joining. Cheers.